Now we start with oil prices. We saw them steady below $49 a barrel as U.S. drillers continue to boost activity, of course countering OPEC's efforts to drain a global glut. Now futures were little changed in New York after falling about 9.1% last week, which is the biggest weekly loss since November. Rigs targeting crude in the U.S. rose to the most since September 2015. Oil last week broke below the $50 a barrel level. It had held above since OPEC and 11 other nations started trimming a supply on January 1st. Now, U.S. crude stockpiles have climbed for a record and production surged to the highest in more than a year, while Saudi Arabia's oil minister Khalid Al-Falih said global supplies are falling slower than expected. Now, Nick Harper is in New York with more insight into this. Nick, welcome to the show. Now, of course, after OPEC's deal to cut output, we did see oil investors quite bullish on the commodity. Is it just the loss of confidence in the deal behind the price volatility we're seeing now, Nick?
Well, there's certainly a number of different factors. Just to talk about that volatility for a moment, when you bear in mind that back in 2014, oil prices for a barrel of crude oil were nearing $100, but then by autumn 2015, they were nearing $30 a barrel. They have risen since then, of course, getting over $50 a barrel, but recently dropping down below that. Last week, we saw the comments from the Saudi Arabia oil minister really seeming to suggest that they were losing confidence in that OPEC deal. His comments suggesting that there would be no automatic extension of the deal in a few months' time, saying that he is perhaps therefore losing confidence that it is a worthwhile thing to do to cut back on production. But we've also seen, as you mentioned, this rise in US stockpiles. We had the weekly stock take last week looking at the US inventories, the level that they're at, and we saw that they rose by 8.2 million barrels in the last week, the 7th week of weekly rises. But we've also seen dropping demand around the world as well. Countries like China that were soaking up a lot of the global glut of oil have scaled back on some of their demand. So when you put all of those things together, it does show the oil industry at the moment in something of a precarious situation.
Now, Nick, some analysts believe that it may only get worse from here onwards. What are the expectations, of course, once OPEC's 6-month deal ends in the third quarter of this year?
That's right, yes. They'll be meeting in May to decide whether or not to extend this as of June. But simply put, if they decide not to extend this, there is a considerable worry that it'll only push oil prices even lower, that it really will not help the global industry. If they decide to extend them, there are some predictions from some analysts that it could help to push up oil prices, potentially in the range of about a $10 a barrel rise, so it would push it back to about $60 a barrel. Of course, this deal was meant to drive up prices. It was meant to reduce the overall global amount of oil that was out there and therefore force prices up. And that, of course, did happen at the start of this year. We did see oil prices rise, but they have dipped down since then. And quite simply put, you could say that this cut in production hasn't had the desired effect. So therefore, OPEC may look at it and decide that there really is no worthwhile benefit in continuing it beyond that June deadline.
Now, like you mentioned, Nick, we have to factor in U.S. shale explorers. They're only increasing the number of rigs and, of course, spending more on drilling over in the U.S. What is the outlook for oil in the longer term with this in mind?
Well, yes, there's considerable concern that quite simply the US producers are soaking up what should have happened in terms of the cutback in production, that they are just continuing to increase the US shale production and also increasing rigs as well. The rig count last week, we saw an increase in active rigs of an extra 8 rigs, taking it to a total of 617 rigs. And there is a prediction from the Energy Information Administration that does predict further US increases of shale output, potentially to levels that haven't been seen in the United States in terms of production since the 1970s, which would massively flood the zone, not just here in the United States, but right around the world. And indeed, within the last 12 hours or so, we've been hearing from Russia's oil major, who's now suggesting that there could be a new price war because the OPEC oil-producing countries are are looking at what the US is doing and thinking to themselves, really, why are we bothering to cut back on production in our own countries when the US is just continuing to oversupply? And therefore, Russia's oil major is saying that there could be a price war between these countries if the US continues to pump as much oil as it does out into the marketplace.
Well, we'll certainly be watching. Many thanks for those insights, Nick. Of course, Nick Harper joining us there in New York.